Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. Learn about fix and flip loans, BRRRR financing, rental, fix to rent, commercial, multifamily bridge loans, business loans, and so much more. And now, your host, Beau Eckstein.
All right, we are live. That's good. And we're actually streaming live. This is my first live stream to LinkedIn, and we're also in our Facebook group. So it looks like it's working. Technology is working today. Anyway, guys, thanks for showing up. I will give you some time, but let me do some introductions here. I've been running a local meetup in the Bay Area for, like 7 years. About a little less than a year ago, I moved to Henderson, Nevada, and I continue to, once COVID is a little bit better, I guess you would say, we'll start doing live events, but we usually do 1 or 2 big live events in the Bay Area every year. And then we would do monthly meetings. And then obviously when I moved, I started doing more online and virtual stuff. And then I started a podcast called Investor Financing Podcast. And I do a show with Vinny on every Friday morning. But today is the first time we're streaming live here on LinkedIn, and we have a great guest for you today. We had him on our show a couple weeks back and wanted to kind of continue the conversation and kind of dive back into it, give an overview. But we got Derek Clifford here, and Derek is in the Bay Area right now, and he's got a great story, and I think this will relate with a lot of people that are going to watch either now or in the future. And Derek's got a full-time job as a project manager, a very successful project manager. And then a few years back, he got into real estate investing. And he's a very kind of systematic type, analytical guy. And, he started buying smaller single-family properties. And then I think within his first year, he bought 13 rental properties. And then he's grown it from there. And today now he's investing in multifamily properties, which he's really excited about. But also what we're going to talk about today is he just released a book, and the title of the book is called Part-Time Real Estate Investing for Full-Time Professionals. And he's going to show his book right there. And I just love the title of the book because it's so important. As many of us are W-2 employees, or even if you're, a salesperson, 1099, it's important to start taking some of our money that we're making at our day job and invest in passive income real estate. Although in the beginning, it's really not passive, because if you really want to supercharge, you're going to be involved as a general partner. If you have a lot of cash sitting around, you would be maybe a limited partner in the deal. But both ways, you got to kind of learn the fundamentals. And I think your book does a great job of walking people through kind of the investing philosophy. I'm going to put a link up to your book in Amazon too. So I suggest you guys get it. There's hard copies and then also Kindle?
That's correct. Yep.
Oh, good. Well, Derek, let's kind of dive into, a little bit more about your background as a project manager, and then what really got you started in real estate investing. And then kind of lead into where you are today and plans for the future.
Yeah, absolutely. First, Beau, thanks. It's an honor to be here again, actually. And also for your first time on LinkedIn as well. It's an honor. So cool. Glad to be here. But yeah, just backing up. I don't want to spend too much time on this because I'm sure we've got a lot of stuff to cover. But I'm a project manager for a utilities company out here in the Bay Area. Most people in Northern California know which company that is. And I've been doing that for about 6 years now. And although it's a great company and they're doing a lot for me, I have great benefits and everything, I realize that I'm slowly becoming dependent on them. And I didn't really like that feeling very much. So earlier on in my career, I decided that I would try to find a way to get myself some other income coming in on the side and try to make that more my main thing. So kind of jumped in with heads first actually into it and became an accidental landlord when we first started out. And, long story short there as well, my wife bought a condo about a month or so before the 2008 crash. And that was up in Washington State. And by the time we were ready to sell it and move to California, she didn't have enough equity in there to be able to cover the mortgage that we had taken out on it. So what we did was we're like, okay, well, all we can do is just rent and just kind of rent it out and just wait this thing out. And within the first couple of months, we started getting these paychecks coming in every month, right? It was enough to cover the mortgage, and it was enough to cover insurance and taxes and all of that. And then it kind of got me thinking, like, boy, I've been looking at like stock investing. I've been looking at trying to find businesses or franchises, and I just never really knew much about real estate, but this kind of just fell into our lap. And we were getting all these positive, cash flow checks coming in. So it got me thinking, well, what happens if I actually tried to do this on purpose? And so once I had that light bulb go off, I spent like a year, and Beau, you know me pretty well. I'll spend a lot of time analyzing and reading as much as I can about things. So I just went in there and studied as much as I could, probably spent about a good year and a half listening to podcasts from Bigger Pockets and from folks like you. And soon after, I was ready to deploy my cash because I'd also been saving money up while I was building this enthusiasm, and then systematically found a way to get myself into a lot of rentals really quickly. So that's how it all started.
That's awesome. I love the story and the journey that you're on. So kind of going back to the single family properties, can you kind of tell me, where did you start buying local in California? Did you go out of state right away? What was your kind of mindset, like how you can take what you've saved and deploy it?
Yeah, great question. So when I first started, I figured out that being local, there's some advantages there. And so I didn't realize, like, I knew that there were some disadvantages from investing in California and some disadvantages, but I didn't really, like, I knew them intellectually, but I didn't actually understand them well until you actually go through the experience. So we bought a property in a place called Antioch here in the Bay Area, and it's one of those developing areas. It's an area where I didn't know too much about it because I'd never been there before, but I knew I needed to take action. That was the one key, is that I realized that, like, I was spinning my wheels trying to find the perfect investment that would return, $1 million straight out of the gate. And I realized that I shouldn't be doing that. I should try to learn on my first property. So I went out there, got that under my belt, and had 2 evictions, had a nightmare rehab to do. And it was just a real pain. But soon after, I started learning about investing out of state. And so I took that equity and did what was called the 1031 exchange. And that became the basis for a lot of my property out of state. But in addition to that, for me, it was just good old, like, saving up money, the old fashioned vanilla way of just saving lots of money up and getting ready to buy a bunch of rentals in a cheaper market.
That's good. So then can you tell us what markets you moved into in out of state?
Yeah, so we went to the Midwest markets because we really liked the cash flow. Like, that was more appealing to us than, trying to do some appreciation investing. So we went out to Indianapolis and Cleveland. Nice.
And do you prefer one city over the other right now?
Yeah, for the time being, like, I like Cleveland a lot, but Indianapolis just seems to be stronger right now. So hopefully I'm not losing people in Cleveland right now. They're hopefully not shutting us off here. But I really like Indianapolis because it's so diverse, the job market there. Plus people are moving there like crazy. And it's still an affordable place to live. The city's got great leadership. And, everything is just, it's a really great place to live. And there's a lot of places to invest, a lot of places in transition. And so it's one of the economies that I really, really like and really believe in.
You're listening to the Investor Financing Podcast. We'll be right back after this break. Are you looking for funding? Are you getting frustrated trying to find a lender? Visit investorfinancingpodcast.com and click the Get Funding button. Complete the simple form and schedule a free phone consultation with one of our placement specialists. We have a proprietary directory of funding partners that can help you get the funding you need. It's fast and easy to explore the options available for your specific needs. Don't wait. Visit investorfinancingpodcast.com and get connected.
What's been your biggest learning lesson on the single family type real estate acquisitions out of state. What's been your biggest challenges?
Oh man, so really, I got to say property management has been the toughest thing. And the reason that I say that is whenever you go buy your first rental property out of state, you're so dependent on these people, right? And everyone knows eventually after buying their first couple of rentals in an out-of-state market that when you fly into that market and you're starting to buy up properties, people see dollar signs over your head, and they I don't want to say they take advantage of you, but they're more apt to charge you a little bit more. They're more apt to say, oh, that's not included in the scope, or just little small things here and there that add up to be a lot. And so finding a team that you can really trust and rely on is super important. And it took me a couple of years before I was able to actually build a network of people, not only property managers and contractors, but also other investors who had suggestions and ideas, and we bounced ideas off of each other and started like referring people to each other's networks. And that's when things really started to take off.
Yeah, I think that's the key too. That's kind of the same experience I have, like, especially when you're talking about single family homes and duplexes and triplexes, right? Like it's different when you're going out and buying a big apartment complex, because you get more of like a professional, or you should be getting more of a professional management company. But the little mom and pop property managers that are managing a lot of these kind of smaller markets, it's hard to vet them out, right? And you're really relying on them. And I had a conversation the other day actually, and I finally said, listen, it's really not. I mean, the market's a big thing. Don't get me wrong, but when you're buying single family homes and duplexes and things, it really comes down to good property management. That's the real key, because most of the areas you're going to buy in are going to stay rented, right? The good thing about Indy is that you guys have had, not only is it a cash flow market, you've also had a lot of appreciation. Yeah, so you've done well there. And it looks like, from the outside looking in, it looks like there's huge job growth, right? There's a lot of like young professionals that are deciding to live there, and there's a lot of I think there's a big move now for people to go and buy these older homes, right? Because they can, when I'm buying properties in different parts of Indiana, right, you can buy stuff for $20,000-$30,000 that needs to be completely renovated, but people are starting to like get the idea, hey, this makes sense. I can go in and be all in on a house for $60,000, right? Like, and then you look at the Bay Area where, you can't even buy in San Francisco, a 500 square foot condo would be $1.3 million, for like, so it just, I think you're seeing the movement, and especially now with COVID, the only downside to the Midwest is it gets cold and it snows.
Yeah. Yep. And there's bugs, lots of bugs.
And there's lots of bugs, but yeah, I love it during the summer though. Like when I'm driving around Indiana, it's just like the openness, the green. It's actually a beautiful place.
Really is.
Yeah. And so now let's progress. So you got a good portfolio going of single family properties. At what point did you say, I need to start buying a multifamily properties? I need to like step it up because, I need X amount of single family homes, or I could just go buy one multifamily property and get the same, I can get 10 times more cash flow. When did it really kind of click in, or when did you get the courage to like say, okay, I'm going to start underwriting deals?
Yeah. So actually this was all part of my big master plan that when I was doing my year and a half long study, I knew that multifamily was going to be the end result for me. I just didn't know how to get there exactly. It seems like such a daunting thing, right? To go straight into multifamily. And, I've learned that that's not necessarily true, but, for me, I like to take baby steps. And so that approach worked for me. And really what my strategy was to build up my single family portfolio to max myself out of the Fannie Mae, Freddie Mac loans, like the small balance residential loans, which, Beau, is usually capped at about 10 per signer. So if you're married, it would be about 20 if you both have W-2 income and qualify for the loan. So what I did was I capped myself out at about 10. And then I started focusing on trying to build my multifamily portfolio because I wanted time on my side. I wanted to get into the market right away as soon as possible and let appreciation and debt pay down and all of those other great things that we get with residential real estate and any real estate to start working for me while I figured out my next move. And my next move came pretty quickly, actually. We went into multifamily. I went out there with a couple of guys, and we tapped one of my wholesaler contact connections. I wanted to pass that along to some of the other fellow investors who have been wanting to invest out of state. We flew out there, met the guy, and we said, "Oh, by the way, we're looking for multifamily too," just wanting to see what he said. And he drove us by an 18-unit mixed-use multifamily property. And it was completely run down. There were people that were living in there that were paying cash rent to the owner, who was driving all the way across town every week to try to collect rents. And I'll kid you not, Beau, in the middle of closing, while we were trying to close, the seller came to us, and we only had like a 15 or 20-day close because it was a wholesale deal. But in the middle of escrow, or while we have the contract open, the seller came to us and said, "Hey, you guys, can I borrow $2,500 because I have to fix this furnace with one of the residents living inside of there?" And we started like scratching our head, like, oh my gosh. But we ended up going forward with the deal, and we went back and forth and had the same problems that you were talking about before with the team, right? Not having a solid contractor, not having a solid property manager who worked in that space specifically. And it was just too much for my current network to handle. And so that took us a lot of time to sort out. And eventually we got the thing stabilized. And, that was only about a year or two after I had finished acquiring all of my rental portfolio. So I just kind of fell into it by just asking questions. And now, again, I'm trying to do it a little bit more intentionally. So you can see there's a pattern with me, man, where I take action, and maybe not absolutely the perfect deal, but I want to get my shoe in the door so that at least I know the terminology, I know how it works, and then I have a track record to be able to look back on and benchmark in deals going forward.
I love it. I think that what we're hearing in your story too, and which people need to hear this, is that the important thing is that a lot of times you're going to get into tough deals. I mean, that wasn't your first multifamily deal. Wasn't like a cosmetic fixer. I mean, it was a heavy lift, right? Out of state. I mean, it's probably the hardest thing to do with that many units. Like it was that big of a rehab. So, but the thing is that I'm sure you went through times where you kind of were kicking yourself, going, "Why did I do this? Why did I do this? Why did I do this?" Right? But the thing I've realized about real estate is that you got to stay focused, right? And you're going to run into problems, and you just got to kind of drive forward, because the natural progression in real estate investing, at least for people that don't have a ton of money, is they got to buy C-class properties, right? They got to buy properties that need a lot of rehab, unfortunately, because that's where you can make the most amount of forced appreciation. And so you got to be prepared to do some heavy lifts. And a lot of people probably after that experience might have said, "You know what? I don't like this," right? But the ones that can kind of go through and torture themselves through the pain and go, "Okay, it's really not that bad," right? And then you kind of build walls up in your body, like where you're like, you get used to it. After you've rehabbed enough properties, you get used to problems, and you usually just work your way through them. I do know people out there that have they kind of bypassed those kind of heavy value add deals, and they went straight for stabilized properties. And I look at that and I go, actually, that's not a bad idea, because there's a lot less, things that can screw you over, but most of us have to start at the bottom and work our way up through, these type of properties. So that's an awesome story. Now, kind of like progress from there, now that you're getting that stabilized, and then the theory behind your book, and talk to us about, how you just wrote a book. And I think you said in the past it was like 30 days you wrote the book. Mm-hmm. And did you teach yourself how to write the book? I mean, I want to go kind of walk us through that process too.
Sure. Yeah. Well, first of all, I want to make sure that everyone understands, including you and your audience, that everyone has a book in them. Everyone is an expert in one thing. There's without a doubt. So the book doesn't have to be very long. It can be 60 pages, and that's really not too much to write. So really, it has to start just like everything. And that's kind of what I touch on in the book itself, is that it all starts with motivation, right? And what's your end goal? So if you have the motivation there, then you're going to make it happen. And so that's what I spend a lot of time working on the book on, is motivation for people who are just starting in real estate investing, whether they want to go actively and do their own single family home portfolio, or they want to invest passively in another multifamily syndication, someone else's property, right? Or you don't know which way you're going to go. But backing up and answering your question about book writing, I did work with self-publishing school. So shout out to them for sure, because there's no way that I would have been able to figure out and navigate all of the things that you need to do in order to make a successful book launch, and also things to look out for, because it takes people years to write a book, to go through all the process, because you're learning the hard way. If you don't know that editing is going to take you 3 months, well, you better get on the editor's list before you even start writing the book. And so those are things that school helps teach you to help accelerate the process and make it flow a little bit better. But last time that I was on, Beau, I think you and Vinny were kind of impressed with the way that I had written it in 30 days. It's a 190-page book that I wrote in 30 days. And really, it just comes down to motivation and setting a goal and just hitting it each day. So Jerry Seinfeld, I believe this was a story from him or someone. He said that the way that he became so successful in stand-up and in writing jokes was that he had a big calendar up on his refrigerator. And on the calendar, he put an X through each day that he was successful in writing 4 or 5 jokes or something, right? And after a certain point in time, you start to be attached to doing those red X's, because you start building this chain, right? And if you're motivated to continue writing jokes or do whatever it is that you said you're going to do, because you don't want to break the chain on that process. So that was kind of the mentality that I brought to book writing. So I had a specific number of words that I wanted to write, because I knew how long it wanted to be, or I wanted the book to be for people who are working a full-time job, which is not too long, but also not too short either. So I was aiming for, somewhere around the 150-page mark, with really big font sizes and so on and so forth. So that translates to about 30,000 words, somewhere around there. And so you take that 30,000 word goal and you just split it up over however many days you're going to give yourself to write. And so for me, that was 30 to 35 days. So I gave myself about 1,000 words a day to write, which is maybe about 2 pages, single spaced, size 11. And then, the key to that, I can keep going if you want, Beau, but the key to that, go ahead.
Yeah, no. So can we kind of dive into the topics of the concept of the book, and walk us through what we're going to get when we read the book?
Yeah, sure. Thanks for letting me do that.
Yeah.
So when you read the book, you're going to find out about my story, what I did, and my blueprint as to how I was able to get all of that portfolio started, including literally a Gantt chart. So for those project managers out there, or people who have run projects before, I literally show you how long it took me to underwrite properties, how long it took me to contact brokers, and do all that. So that way you can gauge where you should be, when you start the process. Anyway, when you first start out, it's all about motivation. So I start out with why you should invest in real estate. What's the big deal? Why would you even do this? So we go through all of the great advantages that you get for investing, regardless if you're doing active or passive. Then we talk about the disadvantages, the things that you will run into, and then ways to fix them, or ways to help prevent them from occurring. And then if you have a significant other, if you have a spouse, right, making sure that they're on board, making sure that they're hopefully aligned with your vision so that they can help you succeed, right? And even in little ways, days that you're so focused that you're trying to close a deal, they can cook dinner for you rather than, that really goes a long way. And it also helps you get permission to spend time and energy on this, because you're going to need that when you first start out if you're building your portfolio. So getting your spouse on board, then checking to make sure that you're financially and resource and relationally ready. So obviously, if you walk into this business and you have no cash, that's ill-advised. You can do it, but I just think that the best way to start, especially if you're a busy full-time professional, is to leverage that you have a successful career, and just start with 1 or 2 properties by doing it the vanilla way, by putting 25% down and just going in. And then at that point, then I start getting into the techniques and the mindset, things to expect, and like, the learning curve effect, and how things seem so daunting right now. But once you finish your first one, the second one goes exponentially easier, and then exponentially easier after that as your team gets built. I just kind of walk you through all those things, as well as some tools and techniques to keep you on track while you're trying to build your portfolio, no matter where you are, if you're starting off or if you're already got a few properties. Then I'll give you my blueprint, and then we talk about multifamily investing to see if that is actually for you, if you don't want to be hands-on, and then how to select an operator. And then after that, I'll make sure to say it's your turn, and then provide some tools for you to execute on what you've just learned. So kind of walk you through the whole book right there.
No, I love it. It's great. And I think that, so this book's really going to resonate with a newer investor, and probably, a W-2 employee or an employee that might have a good savings, but probably knows there's a better way to grow. And I just look at, like, there's at the end of the day, if you live in the Bay Area, for example, and you make $100,000 a year, you really have a little bit left over, unless you're an incredible saver right at the end. But people are doing it. They're, stacking away money in their 401ks. They may be able to roll those into self-directed stuff. But I think your book is really good for somebody that wants to open their mind to, like, okay, like, here's the mindset I need to start, getting into real estate investing. Give you like an overview, right? Like, if I was sitting on a lot of capital right now, I would probably just invest in operators, right? Like, I think, for somebody to go and buy a building in the Midwest and try to fix it up, and it's their first deal and they're working like 60, 70 hours a week, it's very difficult to do that. Versus like, hey, I can get super good returns. I can put 200 grand in this deal, right? And get sometimes even better returns on your investment, because you're not even working, right? So what real time do you have in the deal, right? Other than vetting the deal and then reading your quarterly reports. So right. I think, ultimately that's a place to be, right? Is to be in that position, because you have the less stress. I look at it as how much time am I going to spend and how much stress is it going to cause me, right? And flipping houses is stressful, unless you're just some super systematic person and have a really good contractor. But buying fixer rental properties is a lot of work, right? Like, if you really look at it, what else is there to really become passive? And that's to invest in an operator or a syndication, or potentially lend money, right? Those are kind of the ways that I think people with money can really kind of supercharge their retirement, is by investing in like trust deeds on loans. Like, from my world, because I do a lot of private lending and things like that, right? There's somebody usually with a lot of money, and they want to deploy it, and they like to lend on these 12-month bridge loans, because they're getting points, they're getting interest, and they're paying off. And then there's other people that do that in conjunction with investing in syndications. Like, they might invest in multifamily, they might invest in office, retail. There's so many asset classes. But I like the fact that you really dive into, like, what you said earlier. You said you were willing to take the risk just to get started. You knew there might be problems, right? But you worked through them, and now you're here today, and each problem that you overcome takes you to a different level. And now, you might be buying 60-unit buildings, right? Then that's another level. And then the next level from there is a 150-unit building. And then the next level from there is a 300-unit building. Then all of a sudden, you're the guy that's buying a $30 million building, right? And like, people are going, how did you do that? How do you do that? Right? And that's the progression of real estate, which is why we all have that dream of, like, okay, one day I'll be there.
Absolutely. I think it's really not for everyone, because there's two types of people. There's people that understand that real estate investing is a place that they want to be, to either diversify their portfolio, or they just want to learn more. Like, they don't know what they don't know. So, it's impossible to know exactly what is possible with real estate investing. So you have those folks who want to mainly become passive. And then you've got the folks that want to be like, they have a little bit of experience, like maybe their family members have done it and they want to be active. They want to be involved in the investment. So I want to make sure that they have the tool set to be able to look at both of those ways to invest in real estate, and then also give them ways to figure out which one they are. I have a few quizzes interactive that are in the book that link to a page on my website that helps you find out which type of investor you are. But Beau, you're absolutely right. Like, I think that in order to get the geometric progression going, you can do that certainly as a passive investor, but it takes a lot of cash to do that. You're gonna have to learn some new skills and take some risk if you want to see some of those fantastic doubling of door counts and equity. So that's just my 2 cents on that.
When I was flipping a bunch of properties, my mom and dad would always say, "Oh, we want to flip properties with you." And I go, guys, you don't realize it's a lot of stress. You know,
Yeah.
It's a lot of work, it's a lot of stress, and sometimes things don't go well. But you know, for people see it on TV and they think it's easy. You know, just like everybody they'll go to a seminar and they'll go, "Oh, I'm going to get into real estate," and then you see them post 6 months later, "Oh, you know, I'm still haven't found a deal. It's hard." And then there's others that, you know, they get in real estate and they just take action and they buy 13 properties their first year, right? So there's just differences in that fact. My dad did, I think I did tell you this. My dad's like, he doesn't watch any of my podcasts. Usually I show him, but he watched yours and he like, first time he's really given a huge compliment. He's like, "I like that podcast. It's really good."
That's so
and
nice.
that kind of stuck out of my mind. So, I mean, so now kind of like, tell us where your focus is. Obviously it's multifamily. So you're harvesting and harnessing relationships with investors now. Like, what's your mindset going forward on that?
Yeah, you know, it's thank you for asking that, because I you know, up until now, I haven't really taken a moment to step back and see how much my focus and my mindset has changed. Because back before, when I was investing and deploying my own capital, it's a lot different than now. I'm in the business of actually trying to build trust with people and telling them, like, here, I found this opportunity and together we can take this down and do it. And I have the experience to be able to put the pieces together. And here's the fantastic returns that you're going to be able to achieve. So that mindset is so much different than the W-2 mindset, right? Of just, you know, doing your job, like clocking in and then clocking out, and B, investing your own money. But now there's all kinds of different dimensions involved. Like, I've got to brand my website. I've got to do webinars and podcasts just like this. And so my mind is becoming more expansive to be able to share more of what I know and who I am with the universe. And so that's really what I'm just trying to do. I'm just trying to add as much value as I can to as many people out there. And I just know that in the future, I'm going to trust that it's all going to come back anyway. That's not really what it's about. I just want to help people. And me wanting to help people so bad is to help retire people, help get them into you know, financial independence by using real estate investing as a tool, and help giving them and their family an easy way to tap into that through what I'm doing, or either directly through investing in my offerings or in someone else's offerings, and just learning how the whole process works. So shifting away from how can I maximize return to how can I add value to others. That's the big mindset shift for me in the last couple of months. Actually, it's really been taken off since the book came out.
And it's a game changer to get your first rental property and get that first $300 rent profit check after expenses each month for that one house in Indiana, right? Like,
yeah.
Then you go, "Oh, okay. Oh, it's so great. I get $350 per house, you know, net, or $400 or whatever it is, right?" And then you go, "Oh crap, I got to get, you know, 200 of these houses."
Yeah, that's right. If you live in the Bay Area, for sure, 200 or 300 at least.
Yeah. I look at it now, though. I you know, that I look at it, and I like putting the whole, add up all your outgo, what's your net cash flow at, get your net cash flow, your passive income up to that, you know, your monthly nut, your monthly expenditure. And that's step one to like financial freedom. And then it's a couple more clicks, and then you got more passive income coming in than you need, right? And like, to get to that level, so you could break it down. I mean, you could if you wanted to, you could have just focused on single families, and it might have, maybe with multifamilies, you can get to your goals probably in half the time or sooner, right? Like if you had a goal of $15,000 a month of net passive income, right? That's going to take in Indiana, I don't know, say 20 doors or whatever, 25, 30 doors maybe, versus going out and being able, you can do that on one apartment complex.
Yeah, 100%.
And so that's the beauty of it. And then also, from the lending standpoint, right? Like the lending standpoint is really based on the income of the property, right? So yes, you need net worth requirements with the sponsors, but it starts getting away from you a little bit more than like going to a normal bank where they're like, what's your debt to income ratio? What's that? They're really looking at the property to see, is the property a good investment? Because there's a lot of money out there for good investments. I mean, it's a little bit more tight now with COVID, but not so much in the multifamily space as other asset classes. So that kind of brings me to my next question. Is our world is like crazy right now. Like it's like, I've been working out of my house for 7 months now, like without getting fresh air, other than our gyms are open here, but the world has changed. Like sometimes I stop and I go, wow, we're all wearing masks. We're all like going to the grocery store. We're all like this. We're all used to it now too, which is kind of good. But there's businesses shutting down. There's an increase in bankruptcies. So at the end of the day, what do you think the next 12 months gonna look like? With elections going on, with so much turmoil. I mean, what's your kind of mindset going?
So you're asking me for the crystal ball, right? What does my crystal ball say? So I don't have a crystal ball, but what I can tell you, obviously election years, most of the time they haven't bode well for the economy. And this time there's a lot on the line. There's a lot of financial weakness right now. And you can definitely tell over the last couple of years, things have shifted from a market that's going up to now there's like mixed signals everywhere. So, rather than me just kind of looking at one or two independent indices, like I'm seeing through the media and through Google Trends and through conversations and just general conversations with brokers and lenders and everyone else, that something's shifting for sure. You have the COVID reserves that are changing for lender requirements right now, right? You have things that are just kind of shifting a little bit. So what I'm trying to do right now is even though it seems like it's a problem, there's always opportunity on that as well for everyone, right? Like as long you just have to take the problem and just reframe it, right? You can't be afraid of it. You just have to like use your brain to try to figure out what to do with this. So even though I see a potential for lots of unemployment to come and especially in the C-class segments right now, lots of people that are essential workers or those that don't have work from home jobs that don't have anything to do with the internet, but are more like delivery type or essential work. I think that segment's going to get hit pretty hard, but I still think there's going to be a good amount of economic activity in that segment. So C-class properties, I think, are going to start to like not perform as well. B-class properties are going to follow that trend just a little bit, but then I think we're going to see a rebound once everyone adjusts to whatever the new normal is going to be after COVID kind of dies down and everyone either gets used to it or the vaccine comes out, or the unemployment numbers start catching up with us. I just think that in general for real estate investing and especially for multifamily apartments, for many reasons, it's going to be the premier asset class to invest in for many, many reasons. For being able to borrow money at near inflation rates right now, for being able to leverage, 80% of the value of a property and only bringing 20% of cash to the deal. Like that's a phenomenal advantage. Plus all the taxes, the cost segregation, everything that you get with that. So I think that the future is bright for multifamily. There will be some sectors like C and B class properties and maybe even A and D class. So almost all of them are going to suffer from pretty much at some level. But I still think that, B class properties are probably going to do the best and C and D class properties are going to get hit the worst. A class properties will take a hit because people will probably not want to spend that much or the comps will end up sliding down a little bit. But I still think there's enough demand in the U.S. economy right now to be able to support healthy rental income on these properties, and thus valuations still stay relatively strong.
Good. I like what you said, and I agree with pretty much all of it. You know what's interesting right now? We're at a historic low in many markets with single family properties.
Mm-hmm.
That blows my mind that even here
Yeah.
in Las Vegas, we just set a record for our medium home price. You know,
Yeah.
and we have a higher than normal unemployment rate, obviously, with the casino industry and the hospitality industry. So it's just weird. It's just like it's going against the grain.
Mm-hmm.
But there's also a great relocation happening in many
Yeah.
markets. We're getting
Yep.
a lot of Californians here. Californians, stay out of my state. You know, and I'm a Nevadian, but you're getting that, and you know, you're getting people moving out of the big cities. Like, I mean, people are moving from San Francisco, right? And they're moving to Oakland, and like they're moving to the East Bay. So the East Bay is just booming from,
Yeah.
you know, so. And then I think the world's going to change in many ways. I think after this, I mean, I was just literally thinking the other day, in my 42 years on this earth, I've never been in a pandemic. And like, it's weird. I mean, I personally am not too concerned. Whereas, you know, I have family that have health issues and things like that, and they should be concerned, right? Because it's serious. I mean, you know, I wash my hands, I stay away from people. I do go to the gym, which is kind of scary, but I go really early. And we're in a whole new world. But I agree with you. I think right now is we're going to go through another shift of huge transfer of wealth for those people that can take action on it. So
Again, that happens every single time that we hit a cycle. And, you know, Ray Dalio, I don't know how much you follow his material, but he's saying that, you know, there's short-term debt cycles that just cycle through every 7 years, but every 100 years or so, there's a long-term debt cycle. And what that usually means is either a collapse of a currency or some other country that overtakes economic strength of the current world leader, right? And we're starting to see a lot of those things intersect. I'm not saying that, you know, China or some other country is going to overtake the United States, but GDP is getting pretty close. Like their gross domestic product and economic power is kind of getting close to where ours is. And so no one really has faith yet in the Chinese currency or in Bitcoin or anything else. So the U.S.'s world reserve status or the currency reserve status for the whole world is still with the dollar, and I don't think that's in any threat. So that's going to contribute a little bit more to foreign investment here, and just keeping the value of the dollar stronger than any other currency out there. So that's good for us. That's one thing I wanted to mention. And then with COVID, you also have people who are working from home. So, you know, just picture a W-2 employee that's working for Facebook or working for Google or something in California. What's to stop them from, if they're never going to go back to the office again, what's to take them and their salaries, right, to go all the way to Indy or to Cleveland, right? And with their $200,000 a year salary, they can end up buying a $300,000 mansion over there right now. Like that's changing the landscape of everything at this point. Plus, you have people moving out, like you said, from the urban cores to the suburbs. That's driving the demand. And I think we usually see in economic cycles that they end up coming back into the urban cores once the economy starts heating up again. But who knows what's going to happen? You know, like you got COVID, you got the dollar reserve, you got the currency itself, you have long-term debt cycles, you've got unemployment, you've got the world economy. And so everything is so interrelated. So that's why I like to just look at a whole bunch of different indicators and try to figure out like what that means, what that means for everyone. So again, collective wisdom is much more important than any one person.
Yeah,
that's what I would say.
I have a friend that was got a bunch of money stashed, and he wants to buy a property that he can Airbnb, and you know, you can get a residential loan, you can get 80%, you know, at 2.75 fixed for 30 years or whatever. Yeah. And you know, what concerned me was I looked at the price that it traded at 2 years ago, this house. Mm-hmm. And it was like, I think it traded at 260 or 274. And now it was listed at 499. I mean, it was probably renovated since then.
Yeah.
Right. But I'm just thinking, wow, that's crazy. But then we kind of walked through it, and his payments set for X, and if his Airbnb numbers, come in, he'll cash flow like $2,000 a month, right? Because it's in a really good part of for an Airbnb. And then if you're not in a rush to sell, right, and you can ride out, because that 2.5% rate or 2.7% rate, how much is that going to save you? Because even if the price drops down 50, 60 grand, because of a little bit of a dip in home prices, if you're not planning on selling and your payments fixed, it doesn't really matter. What's my point of that? Because I think he was asking me like what my opinion was. And honestly, my opinion is I think you're overpaying, but I didn't look at it, if you look at it from a cash flow perspective and what his goals were, then you can make it work. Because at the end of the day, we have a housing shortage, right?
Mm-hmm.
There's more people than houses needed, right? So, and the builders aren't building enough. So,
yep.
What does that say? So at the end of the day, there may be some fear that comes in the market. Like, I think what happens in majority of a recession though, is things aren't going well, but what happens is that people get nervous, right? And then when people get nervous, they do stupid stuff like walk away from properties when they don't really need to walk, right? In our last downturn, people were walking away.
Yeah.
And some of them, it was a good strategic default, but some of them, if they would have just held on because the property was paying for itself, they wouldn't have got a foreclosure. They wouldn't have got a short sale on the record. They were breaking even or cash flowing, so it didn't really matter to them. And now today it would have been worth $150,000 more, right? Yeah. So you have to think through these kind of things, as people that own real estate and business people.
In general, Beau, like I think you and I were talking about this one time, either at an event or something, but we both agreed if you can hold real estate for long enough, it's going to work out. It always does, right? Because as long as the population in whatever market you're in is increasing, and that trend stays and keeps applying, you're going to be able to make money on a real estate transaction. It's just going to take a while. It's going to take some time. So it just depends on what your time frame is, how aggressive you want to be, and how much risk you want to take on. Because on the extreme end of risk versus reward, you've got flips, and you've got you're using hard money to deploy out there, and obviously that makes sense in a market that's increasing, but a market that's declining, you probably want to ratchet that back and maybe go back to lower risk methods, which is buying properties that are relatively stable, B-class rentals in nice metro areas across the U.S. Because who's going to want to there's going to be no issue. You're not going to have an issue finding a renter. It's very desirable. So it's just a matter of how much risk and reward you want to take on and where you want to be in this cycle, right?
Yeah, and also too is I think over the next 12 to 24 months, there's probably going to be an opportunity for a lot of seller finance deals too, and creative finance deals on multifamily, because also these people that want to right now, I think a lot of people are in their mind. They're like, okay, we've made a lot of money on our 20 unit building. They're managing it themselves. They're mom and pops.
Let's cash out.
Right. Let's cash out. And, Derek happens to market to them directly through using some software and finding their names and email. Mm-hmm. And Derek calls them and says, hey, I like your property. Do you want to sell it? Yeah, well, actually, we were just thinking about selling it. Right. And okay, well, you guys don't really need the money right now. What about doing an installment sale? Here's the tax benefits or whatever. Right. That's the kind of stuff I really think is what every investor should have in their tool belt as well. Right.
Yeah. That's amazing.
And that's probably going to be in your next book, I'm guessing. It's you're going to start doing these deals because you're like, okay, well, there's ways to do this, right? There's ways to make this deal work by not going out and getting financing. Yeah.
So even my strategy right now you have to get very creative if you're going to try to buy property in this market right now, because like you said, people are trying to cash out, cap rates are really low. And so you can still make things work. I love the seller financing approach, and we actually almost took advantage of that by partnering up with a seller on basically taking over most of the down payment. So they were going to offer 10% of the seller finance, and then we were going to have 80% loan, and then 10% would need to be the cash that we were going to bring to the table. And it was a heavy lift, but it was a mom and pop owner, right? And they were willing to work with us on that. So I think that's going to be you can do a mixture of those strategies. But what I wanted to say is that even doing in a syndication, what the model that I've shifted to now to make it work for investors and to make everyone happy is to basically give all of the cash flow to the investors in the first couple of years until you can force that NOI up in the next 2 to 3 years, right? Because in the next 2 to 3 years, that should be the time horizon in which there's going to be some clarity on whatever's going on with the market. And by that point, if you can at least buy at a point where the market rents where they are right now, you can still make the NOI go up. You can still increase the NOI by just increasing rents to where the market should be, and doing a little bit of rehab. Then what you can do is you can pop the value of the property up, and then the first 3 years you can refinance and return all of the capital back to the investors at the beginning. So in my particular offerings, I'm doing pretty much all of the cash flow that comes out goes straight to the investors, and then when you refinance, everyone gets paid back the original capital that they put in, and then the split between the manager and the investor ends up applying after that refinance, after they're paid back all their original capital. Because as an investor, if I was passive, the ideal situation would be for me to have all of my cash out of a property that I invested in and still have the equity in the property. Like, that is the ideal situation for me, especially in this type of market right now, where, you've got all this uncertainty out there. So as long as you have some way to get the money out in the next couple of years, that's ideal for me. So that's why I always want to think about the investors, try to be a little bit creative, like we were talking about before, and trying to find a way to structure deals to make it work.
What's in it for me, right? It's really not you, the syndicator. Right. What's in it and actually, what I like about that model is that the proof's in the pudding, right? Like, you're not really making any money until year 3 or 4. And so if you do a shitty job, you're not going to make any money. But what I really like about that too, for like the passive investors, is that they're not trapping their money in for 7-8 years. They're talking about, if you can execute the strategy, you can refinance and get them, they're completely whole. So they're 500 grand or 200 grand, they're paid back, plus they've gotten their dividends, their quarterly dividends, and now the rest of the whole period, which could be infinite, for another 20 years or whatever that is, they have no money in, and that's an infinite return.
Infinite cash on cash return.
Yeah. And so who doesn't like that idea? I mean, that's really, really good. And to have a track record like that, I think is kind of a no-brainer. Probably when you get so much money, you could change like when you have investors fighting, like then you're like, oh, we're changing this a little bit because I got to get paid now.
Yeah.
But that I like that model. I call that, and I'm going to write a book about this. It's called C-Burr. So commercial burr, C-Burr. It's called C-Burr. So
love it.
Yeah, so that's good. But anyways,
make sure you clear that with David Green though first.
Oh yeah. C-Burr, he's probably going to hear that and write a book about it.
He might, yeah.
So anyways, we've been going almost 53 minutes now, and we could probably talk for hours, but kind of leave us with some closing remarks. And I'd love to get you back on the show every couple months to kind of see what you're doing now.
Yeah, that'd be great. I would love it. Just in closing, for those of you guys who are out there who are looking to try to diversify yourself into real estate investing, just know that it's a process. It doesn't happen overnight. But one of the most important things that you can do for yourself is to just take action. Don't like jump into things completely headfirst like I did, but don't also be scared of taking a risk, because in this world, and Beau, you know this more than anyone, man, if you don't take any risks, it's very risky for you. So you got to do something. You have to diversify yourself. You have to learn some new skills. You got to get out there and participate. So
I love it. And then where can we get a copy of your book? I know on Amazon, but they can Google your name and book and you'll find it on Amazon. Is there an easier way to get it?
Yeah. So all you got to do is go to my website. It's at elevateequity.org. And then there's a nice little tab there in the front banner there where it says the book, and you can just go there and that'll take you straight to Amazon. And I also have a website too. If you want to get in touch with me and you want to talk, contact me there. It'll send me an email. And then we can go from there. We can set up a time to talk and figure out what your strategies are, what you need, what you want to do, and what you want to get out of real estate investing.
Awesome. I really appreciate you joining us again. I felt like it was a great conversation. I hope you enjoyed it. I'm excited that we can now stream live to LinkedIn because you have to apply, and they denied me the first time.
Oh man.
I don't know why, but I put a better looking profile picture and they liked me now, I guess. So, but anyways, you guys, if you guys want to watch more episodes like this, you can go to beaueckstein.com. You can also go to investorfinancingpodcast.com, and you can watch a lot of great content. And we're going to continue to do these. And oh, by the way, if you need financing, give me a call.
Yeah, Beau's the man.
Yes, we'll figure it out. Thanks, everyone. See you next time.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.